let's talk about the agenda today. I'm gonna quickly start off with a word on swing trading. Just generally, what is it? Why do I do it? Why do subscribers enjoy the swing trading aspect as opposed to, say, a day trading or a more longer-term type of investment strategy? When we talk about attributes of the market, of a market correction, which I think is extremely important to understand, markets that go down have an entirely different character to them than markets that just go up. And I think we're at a pretty good point in terms of timing this year to talk about that. We have essentially a market that is 180 degrees different than what it was up until May 22nd. And then we'll talk about three strategies. First one, shorting the broader market, how. Second one, shorting the most overbought sectors, and how. And thirdly, we're talking about an option strategy. I found that certain markets tend to be very kind to specific option strategies, and the down tape from a swing trading perspective actually tends quite well to one of the option strategies that I'm going to go through today as well. A quick important note, I always mention this one during my webinars. The definition of swing trading here, as far as I define it, is very much my own, although I don't think I'm very far off the mark. But just keep in mind there are different definitions of swing trading. So let's talk about why swing trading. And swing trading it's an interesting time frame to operate in because it pretty much allows you to trade with fairly little stress and at the same time also no boredom. The reason I do swing trading is because I've found that by day trading or the longer term stuff, I tend to look at it a little bit more as a gamble. That's my personal. I'll give you my personal reason why I went with swing trading eventually. If you do a swing trading strategy which has a time frame of about 2 days to 4 weeks, the margin of error for doing a trade a little bit too early or too little bit late is a lot higher. It's a sweet spot, so it's too long for day traders. By definition, day trading is of course within the day. Yet it's too short for institutional investors. And the last but not least, I think what's extremely beneficial to swing trading is that you really have clear, defined stops and profit targets. Swings basically are moves in one direction that usually don't end on one single day. They usually take a few days at least to turn around and form a bottom or a top before then resuming in another direction. So let's talk about what I like to short when the market is going down. As opposed to shorting individual stocks, I prefer on balance to short the broader market. Why? Because as I said, from a swing trading point of view, I like to get above average returns during these more volatile and environments and really pounce on people's emotions. So what I don't want to do, I don't want to risk not making money. Okay. In other words, if I short stock XYZ in the financial sector, there's a good chance it'll go down if the market drops 2%, but it's not a sure thing. Okay, if you are short whatever the bank is you might want to short, and the market goes down 2%, but your stock for some reason bounced on some better expected news or a new CEO, whatever, right? You're going to be very, at least me, I am very frustrated not to make money. So the probability of a trader making money in a down tape by focusing on sticking to indices and sector indices and ETFs, I think are superior, at least from a swing trading perspective. The other thing is that technicals work very well on the way down. They work well on the way up, but in my point of view, technical levels and retracements and some of the technical indicators I use work better in a down tape. The other thing I like to do, I like to define reference and target stop levels constantly. So if we're now looking at the XLF, as I have talked about this one a few times now, Might as well bring up the chart. This is the financials ETF, right, of the financial sector, the S&P 500. If we're talking about reference levels in this ETF, I like to keep them simple, but I like to have them on my charts every single day. Okay. First of all, I like to operate with a simple 50-day moving average. In this case, in the XLF, now moving averages don't. Every stock, every ETF, every index has a different personality. Some moving averages work better for other indices, for some indices than others, or even for us on an individual stock basis. But if we're looking at the XLF right now, there are very simple reference levels you want to map out and trade around in a down tape. If we just focus on some simple trend lines, we'll draw one off the May 2012 bottom, we'll draw one off the November 2012 bottom, and sure enough, we have a first reference point of support right here at the uptrend from November 2012. The financials have not yet broken that. However, from a market correction point of view, this is exactly where I would want to see the first bounce. Okay. At the same time, we have lateral support dating back to the peak here in April before the breakout in April, as well as roughly around the 100-day and 50-day moving average. Again, this is just what works on this, but on average, I find that the financial, the 50, 100, and 200-day work quite well on the S&P 500 itself and its indices, its subsectors, I should say. So again, map out individual levels to trade against, have a plan, and understand that the market is more volatile. Give a lot of room for the market to increase your margin of error, trade smaller size, and shorten your time horizon. At least that's what I like to do. Let's go back to the presentation quickly. Talked about why technicals work great. From a longer-term point of view, I like to also use the 200-day or the 140-day moving average. The 140-day, just like the 150, work pretty well. Work almost as well as the 200-day, depending on the index. If you want to note this down, just maybe play with it. The 140, from a swing trading point of view, a lot of times will tell us if the market is still in a bullish mode or flipping to a bearish mode. Just one little nugget of information there, if you want to note that down. Correlation is high, right? So this goes back to the point I said earlier, short the market, not individual stocks. At least that's my mantra. It doesn't mean I won't short some individual stocks. I'm short a few individual stocks right now that are trading in tight patterns. But more or less correlation is high. So if you're shorting the financial sector, correlation is very high. In other words, the chances that JP Morgan will go down on any given day when the broader market's down is just as high as say Goldman Sachs will go down. And that's exactly my point. If given this high probability and correlation is high, you then pick the one stock that on that given day or week or whatever your time frame might be is not going down, you're going to be very, very frustrated. Quickly on correctly drawing multiple trend lines. I think I just pretty much laid that out. This may be a topic for another day, but I like to draw my trend lines very simple. I connect the bottom dots of any pullback, and you can see on the XLF right now the first reference point we've gotten to, which coincided with the 50-day a little bit, between the 50 and 100-day. The next one will come in rallying off the June 2012 lows. Let's see what the next thing is here. Levered ETFs, that's another thing. I mean, folks always ask me about levered ETFs because they don't like to trade options, and I can understand that. I think Dave made a good point about that. There's a lot less stuff to worry about, margins and all that stuff, and interest rates. At the end of the day, they work to, I just think when you use levered ETF, the 2 and 3 time, or the inverses, you have to just make sure that you trade them, you use them as trading vehicles as opposed to investments, you will lose money over the long term if you trade them for investments. Simple ETFs here, the SEY, IWM, and QQQ that I like to focus on because they give us the most clear signals most of the time. Even also from a candlestick point of view, if you want to look at the S&P 500 signal it gave us on on Friday. With a daily close, we came to a 100-day moving average, it's blue line, which coincided with lateral support somewhat in a range, and it gave us a bullish hammer candle. Doesn't mean the market can't fall further on Monday or Tuesday, but it does mean that the odds of a bounce here, at least a 1 to 2% bounce, are better than they were coming into say Friday, into say Thursday morning.